Nvidia is pouring $100 billion into OpenAI, but not everyone thinks the math adds up. Could this be a major warning sign for the AI boom?
For ages, why could this signal a top or a bubble?
Well, I think vendor financing has a pretty spotty history, frankly. It's been a feature of past bubbles that we've seen. So Nvidia is basically giving $100 million here. $35 million will go back, it's called rough numbers, into Nvidia's revenue down the road. It'll look like revenue for Nvidia, but it's not real cash they're getting. They're losing on the deal. And Nvidia is also guaranteed, underwritten some of CoreWeave's investment too. So this is not to say it's a bubble or there's anything fraudulent here, but it's the kind of behavior that just demonstrates how much capital intensity there is in building out this AI infrastructure at a time where the monetization outside, some of the in-house applications of, say, a Meta or an Alphabet, an environment where the monetization is very unclear at the scale companies have to invest in it.
I mean, yesterday, Mike and I were noting this sort of circularity of this whole NVIDIA OpenAI partnership, Tom. But does this make you rethink some of the holdings that you have in AI? Broadcom, for one, is TSMC, for instance. I mean, do you think now is the time to start paring back exposure, or is this something that you're just remarking on? Because investors could have been making the same sort of commentary for a while now, and they would have missed out on some pretty big stock runs.
Yeah. So I would say specifically on those names, Broadcom is more diversified and a safer play. It's, of course, more diversified in that AI is not its only business. It does a lot of other things in software as well as semiconductors. But within their AI business, it's much more targeted with their custom chips to the Alphabets and the Metas I was talking about, to these more proven use cases around, say, ad targeting or content delivery. We also think ASICs, their custom silicon, is going to gain share over GPUs, the more generic chips over time. So relatively well positioned. Probably our only hesitation around them, why we don't hold more, is just the valuation. Because the good news is they're diversified away from AI. The bad news is that they're diversified away from AI too. And despite my concerns about the capital investment now, if you have a really long horizon, we do believe in AI. It is a great productivity enhancement. If you sort of go down the chain from, who do Broadcom and Nvidia use to build their chips? Of course, it's TSMC. How does TSMC build their chips? They buy equipment from Lam and ASML and KLA and so forth. So that's kind of where we feel like, however the trade goes, those companies will win. They have, the strong balance sheets to survive. They have business in smartphone or memory and other areas that are actually kind of cyclically at a trough. So it's not like everything's perfect right now and there's some room for improvement. So that's, where we like to play AI right now. And a lot of that does boil down to thinking through which are the more proven use cases and which are the ones that, like that MIT study that came out last month where most projects haven't been successes. I think that will continue to be true. And it's going to be hard to figure out which projects will be the successes. So we'd rather not get too speculative around that.
Sure. Tom, you pursue a quality strategy, and those have worked. A lot of the market gains have been those companies that have the strong balance sheets and the strong earnings growth and all the things you would look for. Do you have a concern that characteristic, that factor in the market is becoming a little bit too levered just to the AI trade? You're kind of, chasing the same profit growth streams, or are there other places that you also are playing?
That is a concern. If you screen sort of broadly on quality, as we and others do, you get a basket of stocks that's increasingly a tech sector basket. And that's, with good reason. These are great companies. But I think as a portfolio manager, as an investor, you want to be more diversified than that. So the good news is that's not the only area where there's quality. We like a lot of healthcare stocks. We like a lot of cyclicals and industrials, frankly, too. Or we like some of those state-old consumer-branded companies. And we are probably tilting our portfolio toward that side of quality more than what you'd get if you ran sort of a naive quality screen, let's say, on the kind of characteristics you mentioned. Another way to think about that, there's diversification. There's also valuation. Of course, some of those non-tech areas are not quite as loved as the tech sector is today.